How do you explain the idea of risk it where everything just seems to keep on going up? Bringing the prudence of a long-term perspective to crowdfund real estate investment, my guest today is Adam Hooper, co-founder and CEO of the online marketplace RealCrowd. Welcome to the National Real Estate Forum podcast, episode 215. Thank you for joining me today. I am Dr. Adam Gower, and this is the crowdfund project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital, build wealth, and earn passive income from crowdfunded real estate deals. In pretty much all the conversations I've had so far with the founders of crowdfund real estate marketplaces, what I hear the most often is that there is a need for education. Education of both the investor and the sponsor as to how they can benefit from this new form of capital raising for real estate. There are clearly several perspectives to the idea of education. On the one hand, simply understanding the jargon of real estate is a challenge in itself. While dictionary definitions are easy to find, fully comprehending what concepts mean in real-world applications is a completely different matter. The big problem with dictionary definitions of complex real estate concepts is that, for the most part, they are written by people with decades of experience. Ironically, it is actually a very difficult position from which to try to explain anything. The experienced professional tends to explain things in language only an experienced professional would understand. It's a bit like learning how to speak Japanese by using a Japanese-only dictionary, which incidentally was the masochistic way I went about learning to speak that language. And looking up a word you don't understand only to find it explained in other words you also don't understand. So with an appreciation for that in mind, I have put together a glossary of real estate crowdfunding terms that is written in plain English. No jargon, no assumptions that you have any understanding of real estate, and written in a way that even the most seasoned professional will find refreshing. It is totally free and available at the nationalrealestateforum.org website at nreforum.org/education. Let me know that you would like a copy and I will send it to you right away. And of course, if you have any questions about real estate in general or about how to raise capital or invest in crowdfunded deals, please contact me at the nreforum.org contact page and I will personally get back to you as soon as I can. My guest today, Adam Hooper, is co-founder and CEO at RealCrowd, and he has also prioritized education. RealCrowd is among the most successful of the marketplace platforms out there, and this is in no small measure due to the focus on providing resources that help demystify the incredible opportunities crowdfunding real estate deals bring to the industry and to the investing public. Be sure to check out the show notes to today's episode at nreforum.org/Adam Hooper for links to RealCrowd and the tremendous resources that they offer.
I think there's still a lot of either confusion or misinformation or just misunderstanding about what it is that we do, or the space in general, or the different business models that are in there that hopefully we can unpack a little bit today. Because it's still a relatively new way of doing things. I mean, there's a lot of kind of fundamental mechanics of it are very similar to how it's been done for a really long time, but these new components of it, depending on which area of crowdfunding, if you will, you're looking at, can be a little bit intimidating to try to figure out, but a lot of what we do is just trying to educate both sides of the market on the investor and the sponsor side. So
yeah, you guys do a really good job of that, both online and elsewhere. Tell me a bit about your background and how you got into real estate and how that migrated into fintech, basically.
Yeah, I mean, I guess going back to college, it was actually in the golf business originally. So I went to Penn State, and the major that I chose there, you actually come out as a Class A PGA professional. And I learned very quickly that was it's not as glamorous as very, very changing industry, the golf industry, right? And so real estate had always been kind of a family thing. It had always been interesting to me. And shortly after I graduated, actually moved up to Central Oregon to work at a regional commercial brokerage firm there. So started in 2003, 2004. Really good market. Central Oregon, it was Bend, Oregon, really good market. Got to ride that wave up, and it was a small enough market that we got to do a little bit of everything. So tenant rep, leasing, landlord rep, some development deals, some investment sales, land sales, and you really learn the business from kind of hands-on brokerage. And then from there, wanted to do bigger deals. And in 2008, I guess it was, split off from the firm that I was with to start my own firm with another partner, where we focused on single-tenant net lease deals across the country, mostly brokerage again, and then started getting into some of the equity placement side and helping developers raise capital for those deals, and really liked it. It made sense. I knew there was a need for helping people capitalize their projects, and that kind of grew into another thing. And then it was late 2011, I guess it was, I moved down to join a firm in the Sacramento area as a partner to help build out their joint venture equity team. And that was a big nationwide brokerage firm. And so got a lot more experience there, mostly institutional joint venture, sourcing and structuring joint venture equity. And there was a few deals that we were working on that were sub-institutional sized in $15-20 million range.
So deal size 15-20 million, right? Equity 5 to 7 or so. Yeah.
Right. Yeah. So acquisition was 15-16 million. And I remember one deal in particular, we were selling to a sponsor, a syndicator, very, very prolific syndicator, great track record, great background, very deep capital relationships. And they were out raising capital for this deal. And a sister building came up, and it was, just down the road, very similar project metrics, similar acquisition size. And, we thought it might make sense for them while they're making their entrance into this market, some economies of scale, why not buy this other building too? And his answer was, look, I don't have the capacity, nor do I want to, shut down my operations, go do a roadshow for another 30 days, get the wife and kids goodbye, and go syndicate another $4 or $5, $6 million of equity. And that was a fairly consistent answer, right? For the syndicators, it was just a very, one-on-one analog kind of hand-to-hand combat for raising that capital. Mm-hmm. And so this was, I guess, late 2012 that we had a few of those deals coming together. And this was right after the Jobs Act was passed. Right? April 2012, the Jobs Act was passed. Mm-hmm. And Kickstarter, Indiegogo, a lot of those companies were really at the forefront of this whole crowdfunding thing, all donations-based. And, we were just kind of tired of banging our heads against the wall trying to figure out how we can help capitalize these deals. And it just hit us. Why couldn't we, almost as a thought experiment or joke at first, why can't we crowdfund these things? Mm-hmm. Not really knowing what that meant at the time. And then started doing some research and, talking to attorneys and counsel and kind of doing our sanity checks of, is there really something here? And every step deeper we took, it was kind of confirmation that there might actually be something there. And so that was really the genesis of this was, the challenges that we were facing in our day-to-day world in helping capitalize these projects and brokering deals, combined with seeing this new opportunity to take advantage of this new regulatory environment that's going to be available.
So let me ask you a question then. What was the single most important impact that the Jobs Act had that really changed everything?
For us, it was lifting the ban on advertising private securities.
Okay.
Right. That was the regulatory change that allowed us to do what we do today. And for listeners that might not be as intimately familiar with the Jobs Act as we are, the intent of it was to try to free up access to capital for small and medium-sized businesses. So if you were going to open a restaurant or a coffee shop or a local retailer, to give those small business owners the ability to access capital from different channels beyond just SBA loans or friends and family, to try to increase the ability for capital for startups and small businesses. I don't think real estate was ever the intended recipient of that legislation, but I think it's been one of the bigger asset classes to really benefit from it. And so there was a few different sections of the Jobs Act, the most important of which that we just mentioned was Title II, which created this ability for private investments to be advertised publicly. And so for 80 years, the SEC said, Adam, this is the first time we're talking. I couldn't offer you an investment because we didn't have a pre-existing business relationship.
Right.
So if you were going to raise capital, you could only offer that to people that you had a pre-existing relationship with. You couldn't go to a new group of investors that you don't know and say, I'm trying to buy this building or I'm trying to start this company. These are the deal points, these are the metrics, and this is why you should invest. You couldn't do that. And so the Jobs Act lifted that ban on advertising, radio, TV, newspapers, magazines, right? Any way that you want, you can now advertise that you're raising capital for these specific opportunities. There's some additional restrictions that come with that, of course.
Right.
But we just saw that's a pretty fundamental shift in how the capital markets can function and access on both sides of that equation. To be able to use the internet that has taken what's always been a one-on-one conversation, right? Our conversation here in this podcast, prior to being able to distribute content this way, we would be having a lunch or we'd have a dinner or we're playing golf and we're having this conversation. But now with this thing called the internet, this can be distributed to infinity, right, without any additional effort. And so to be able to take that same kind of a distribution model and overlay that on the capital raising world and in the investment world, and that was just a huge fundamental shift in how I saw this build. And that was just a huge fundamental shift in how I saw this business operating, and one that it just made sense, right? I mean, it had to exist.
It's transformational, really, isn't it?
Absolutely.
So where previously you would have had to have a personal relationship with a developer, right? Somebody in your close social network or business network that you knew personally, who might bring a deal to you and be able to explain it to you over lunch or over golf, whatever it is. Now the world has shifted, and you can advertise your deal online to accredited investors, but you don't have that personal touch. So how does RealCrowd bridge that gap, right, that educational gap between the highly knowledgeable developer and theoretically the sophisticated investor? But the sophistication is only defined. So let's assume that we've got, a sophisticated, a wealthy individual by the regulation, Reg D standards, but doesn't know much about real estate. So how do you bridge that gap, Adam?
That's a question we ask ourselves almost every day. And I think you really hit on it with your first part of that question, is that relationship and that personal connection between the investor and manager. That's something, real estate is very much a relationship business, always has been, and I don't think that's going to go away anytime soon. I think there's always going to be or should be a connection between all the stakeholders, right? The investors and the manager and the tenants and their customers that they're serving. There's always a relationship component to real estate. And so when we were thinking about how to set up this platform, we're really trying to think of how can we amplify both sides of that relationship building, right? How can we amplify a real estate manager's ability to meet and build those relationships? And at the same time, how can we amplify the investor's ability to create those relationships with these managers? So the amplification of this relationship building, and that gets to the very core of how we structured RealCrowd, with enabling and empowering that direct relationship between the real estate company and the investor. On RealCrowd, it is a direct relationship. So as an investor, when you come in, you have the opportunity to communicate directly with that real estate manager. When you choose to invest, you're executing the subscription documents directly from that real estate manager, right? We don't form any blocker entities. We don't aggregate people into our own LLC. We don't try to obfuscate that relationship between the investor and the real estate manager, which on some platforms, there's positive and benefits of both models. Which on some platforms, there's positive and benefits of both models, and some cons of both models. But a lot of the other platforms, you'll see you're going to invest in crowdfunding company 16 LLC, and you have no way to actually interact with the real estate manager, right? There's this kind of level of obfuscation between your investment and the actual manager, and we just felt it was adding layers to this equation versus trying to make it more efficient. And so that's why we've decided from the very beginning to structure this as a direct marketplace where we can really give tools and communication patterns that help enable those relationships and make it more efficient for the sponsors and the managers to manage those relationships, right? I mean, that was, I think, very core to our ethos, is that for this method of raising capital to ever really become a mainstream thing, we have to make it easier for a manager to investors than what they were previously doing offline.
Okay, so hang on, I got to jump in with a question there, right? So as a sponsor, sure. So look, I get that, it's very important, and I think that from an investor's perspective, it's a very compelling proposition. However, from the sponsor perspective, do I really want 100,000 people calling me, right? Because I put my deal up on your site. I'm busy enough. Yep. In fact, the advantage of working with you is to expedite the process, not complicate it. So how do you mitigate that? Or at least how do you mitigate that concern that sponsors may have?
Sure. And that gets to, the first thing we talked about is just the level of, not misinformation, but kind of lack of clarity around what it is that we actually do. So when people hear crowdfunding, they think, I'm going to have, 1,000 investors that are going to put in $1,000, and that's how I'm going to get to my capital. That's very dollars, and that's how I'm going to get to my capital. That's very much not what we focused on. So the average investment on RealCrowd from day one is right around $70,000 per investor per ticket, essentially. And it's ranged as high as $120,000, $130,000 on some certain funds. So, how we like to explain it is what we do is no different from a sponsor that's out there syndicating to existing accredited investors. Mechanically, functionally, very same. The biggest thing that's changed is the means by which they can attract new investors and tell that story to new investors, right? So they're still syndicating. They still get to set whatever minimum investment amount that they want, whether it's 25, 50, or 100,000. They still follow the same regulatory process, filing with the SEC, Form D, same subscription documents, same structure. It's just that now they have this new avenue to reach 25,000 plus members that we submit deals to that they would never otherwise have the ability to tell that story to and to offer that investment to. So that's really the biggest difference. Is it's not where you're having this mass of tens of thousands of investors all asking questions that aren't really meaningful. I mean, you have a very, I think that's one of the surprising things is the level of sophistication and the level of education that our investor base does have has I think surprised us to the good of how sophisticated they actually are with the questions that they ask. So that is a concern on the outside looking in. I can tell you, the 140 plus deals that we've done practically, I don't think we've had any sponsors say, hey, we're just getting way too much activity. We need to dial it back. It just hasn't worked out that way. And I don't know if that's industry wide or if that's more, the kind of deals that we focus on or the sponsors that we work with or the investors that we've been able to attract. But, at a point, and most sponsors are going to take that call or they're going to answer that email. And oftentimes, it works out, and that's how you convert this interest to capital. And that's really what they're looking at platforms like this to do is create that interest and then have a way to convert that into actual investment dollars for their projects.
Don't forget to pick up your free plain English glossary of crowdfund real estate deal terms by going to the show notes for today's episode at the nationalrealestateforum.org website, nreforum.org/Adam Hooper. Okay, so you function as a marketplace. Is that right? You don't take a piece of the deal, you charge a fee to the sponsor for the money that's raised. Correct me if I'm wrong, but you don't charge the investor. There's no management fees.
That's right. Completely fee-free for investors. And as you said, we charge the real estate companies, a real estate manager,
fees.
That's right. Completely fee-free for investors. And as you said, we charge the real estate companies, a real estate manager, a flat fee for using our platform and using the technology to again, just kind of distribute their deal. So it's not...
It's a flat fee. Okay. So, really? So it's not a percentage of funds raised?
It's not a percentage. So we're not a broker-dealer, and that was one of the exemptions in the Jobs Act from registration as a broker-dealer. So part of that is we can't charge a performance-based commission, essentially.
Interesting. Okay.
Yeah. And I think that gets to the simplicity of it, too, right? I mean, we're trying to we're trying to create as much efficiency and simplicity around this whole capital raising process as possible. So that, pay a flat fee, whether you raise $1 million or $10 million or $25 million, that's what you pay to use these services. And then the marketplace is an open marketplace, and it speaks for itself. If you've got really good deals and you've got a good track record, and you can, stand behind your stories.
Actively or have actively invested so far, do you figure?
In total, we submit deals to around 20,000 investors, a little over 20,000 investors. So when we submit a new deal or we do deal updates, it goes out to about 20,000. Some of those are different varying stages of accreditation, right? And that's one of the things that we talked about earlier. When you make these general solicitations, there's a higher bar of establishing how this person is accredited. So in the old school way, which still exists, by the way, true private placements where you're not making these advertisements, you can still do a self-certification, check the box. I certify I'm accredited, I'm worth more than $1 million, or I make $200,000 or $300,000, whether I file single or joint. When you make a general solicitation, the self-certification doesn't work anymore. You have to go through what the SEC says you have to take quote unquote reasonable steps to verify your accreditation. So we use a third-party service to verify that. So those 20,000 are in different stages of that. Some self-certified, party service to verify that. So those 20,000 are in different stages of that. Some self-certified, some have gone through third-party. Those that, everybody that goes into a deal goes through that third-party process. And that's represented just under $200 million of total investment activity into total real estate value over the last 4 years, about $3.5 billion.
Oh my goodness.
I think that's one of the other parts of this equation is people still see crowdfunding and what we do as, maybe it's this kind of fringe experiment on the side. And, we're seeing this become a meaningful source of capital, right? In early days where we'd see deals that would raise $500,000, $750,000, that would be a pretty good result. We're seeing deals now raise, $3, $4, $5 million on a regular basis. If they do really well, maybe it's $7, $8 million. We had one fund, a debt fund. They've actually raised about $24 million through the platform. So we're seeing some fairly substantial amounts of capital being aggregated through platforms like ours, and I think that's what's exciting to us is seeing this like ours, and I think that's what's exciting to us is seeing this become more of a mainstream way to augment how these sponsors are raising capital, and it's really kind of growing up into something that is looked at as a legitimate source of capital, and that's really exciting for us, and I think a great validation for what this model can do. Again, for both sides of the equation, with that access point of people accessing these due deals and sponsors accessing pools of capital that they wouldn't have been able to get to otherwise.
So, what are the biggest challenges that you face and that the industry faces? Do you think at the moment? I listened to I watched a video of you talking in 2014. So just when the industry was really very nascent.
It was early days, yeah.
It was very early. I mean, it's a long time ago already, 2014, when you think about it. And you were talking about needed to do some more educating. And I've heard you reiterate that a few times, even today. So tell me, what are the challenges? What do you think, what would be the most helpful thing that you could see occurring in the industry to really accelerate growth?
Yeah, that's a really good question. I think there's a couple different vectors to take that. First of which is, I think one of the things that we often struggle with is how little appreciation or understanding within the retail investor base of a risk-adjusted return, right? What does risk-adjusted mean versus just chasing the highest number in terms of total IRR or equity multiple? Okay. And so to me, as we look at this industry, yes, we're 4 years in, $3.5 billion in real estate. That's great, but it's been a really good market these last 4 or 5 years.
Right, exactly. You could hardly miss, right? Yeah.
You could hardly miss. It was hard to lose money from if you bought in 2010 to 2013. It was
and did nothing, right? And just sat on it. Yeah.
Right. So a part of the concern that we have, even within our platform and certainly with some of the other platforms out there is, the real estate market is obviously cyclical. We're 8 years into this cycle. We're getting further into the cycle. If the sole decision point that people are basing their investment decisions on is what deal has the highest return, without any appreciation for the risk associated with achieving that return, that's setting the whole industry up for a bad time. And I think part of it was in the very early days, we didn't do any of this product type, but a lot of the other platforms when they started, they were doing a lot of kind of fix and flip hard money, single family loan debt. And the expectation was loan debt. And the expectation was set that this is a senior debt position. So you're in first position. You're getting a 12 or 13% coupon, and it was being billed as this ultra secure investment where you're getting such a high coupon with no real explanation of the risk associated with getting that, right? I mean, hard money loans are hard money loans for a reason. You have to take on some risk to get to a 12 or 13% coupon in a debt instrument. And so I think that unfortunately pegged the expectation of what an acceptable return was so far askew of what a traditional historical, healthy real estate return was, that we've been trying to battle that from day one of, real estate should be looked at on a long-term basis. It shouldn't be looked at, with your entire allocation this asset class on a 6 to 12 month hard money loan, that you can turn a couple times a year and try to get your 12 or 13%. So I think that's just, in the industry, that's one of the bigger challenges that we see is how can we educate people, and that's why we do our podcast, is to try to help people make better educated decisions as it comes to looking at the risk involved with these returns that they're looking at, and not hopefully just chasing that number. I think that's a really, really big thing for the industry, and something that we're always trying to figure out how can we better educate people to make risk-adjusted decisions. And then second to that, I would think, is the accessibility, right? I mean, we've kind of been saying lately, we've made real estate investing available, 140 plus deals, $3.5 billion of real estate value on the platform, but I don't think we really made it accessible yet. And
accessible to who, Adam?
Yeah, so accessible to your, as you were talking, right, the level of sophistication. I feel like today you still have to have a fairly high level of sophistication to be able to look at a portfolio allocation or to choose between 10 or 12 different deals or more if you're looking across multiple platforms. You kind of have to have a fairly high level of sophistication to really make good decisions as to what's best for your portfolio. So I think real estate has been made available at a scale that's never been made available before. But now we need to look at how can we make that more accessible, whether that's through lower investment minimum amounts so that people can better diversify a certain pool of capital, whether it's helping give people tools to look at the risk, right, to make that more accessible, whether it's through education to help make them more comfortable and kind of lower that bar of intimidation with choosing deals. So we're really looking at how can we take the person that doesn't really know a lot about this asset class, but they know they have some fundamental understanding that real estate is a good thing. They just don't know how to get into it or what they should do if they have access to it. And so what we want to try to do with our platform, and that's kind of where we see the next level going, is how can we take that person that knows they can feel comfortable and confident, know that they're making the right decisions towards putting some percentage of their money, allocating it to this asset class and doing it in a responsible, risk-adjusted way. I think that's going to be the key to seeing large-scale consumer adoption of this industry, and I don't think any platform's really nailed that yet, ourselves included. I think that's one thing that we're continually trying to work on. But to me, to get to that mass-scale consumer adoption of investing on platforms like this way, you really need to kind of break down that first hurdle of getting comfortable, building that trust, and the again, I think it really comes down to comfort and telling that story of how you should be building your allocation into this asset class versus just going somewhere to pick a deal. I think there's a big difference between those two different avenues.
Well, you don't want your investors to fail either, right? I mean, there's an inevitability of a cycle. You want side, so the better educated your investors are, right, the more prudent they are and well informed, the likelihood is that they will, with you, survive to the other side of the next cycle. And that's where you really build your strength. And my sense is that's where the next downturn will sort the wheat from the chaff, and whoever survives to the other side will be the ones that will dominate the industry.
I agree completely.
What about the sponsor side? Do you find resistance from them, or is that becoming easier and easier to source deals and to open the doors to sponsors?
Yeah, it's becoming, well, it's always a challenge, right? Again, there is still a lot of misunderstandings, again, as we've talked about in the space and what it actually means to work with us. That story is becoming easier to tell, and I think people are getting a better understanding of what it means to work with a group like us. Real estate sponsors, they're always looking to raise money. So
right.
The value proposition is pretty straightforward, right? This is an easier, more efficient way to access direct capital. I mean, that's a pretty easy value proposition.
So what's the resistance? Why isn't everyone banging a path to your door, do you suppose?
I don't know. I think it's a lot of it comes around, am I going to have to manage 1,000 investors, right? I think that's one of the kind of first level hurdles. I think a lot of people's first impression when they hear crowdfunding is to think of exactly that, Kickstarter, right? People are going to go donate $100 and they're going to get a coffee mug. That couldn't be further from what we actually do. And so a lot of it is that, and I think it's awareness, right? I don't know. A lot of it is that, and I think it's awareness, right? I don't know what percentage of real estate managers out there even know that this is a thing, that this is even a way for them to access the capital. One of the encouraging things that we see is bigger institutions, very, very institutional managers with billions and tens of billions of assets under management are looking at the space. They see something is happening here, and it's on their radar to try to figure out how that can work into their model. Tapping into this retail investor base has always been seen as kind of the holy grail of capital raising, right? If you can efficiently access this phenomenal amount of wealth that's pent up that isn't playing in the institutional capital markets, it's not going through pension funds or life insurance companies or endowments. There is a tremendous amount of capital out there, and if you have an efficient way to access that, massive capital flowing through the platform increase. We're starting to see the amount of deal raised the amount of capital raised per deal increase, and it's getting to the point where we're already seen as a viable source of capital, and I think that's only going to grow. We're still, on one of our last podcasts, I think it was Mark Roderick, asked where are we at in the stage of this business. And I do think we're still just building the stadium, right? I don't even think the game has started yet. I think we're still just setting those foundations for what does this industry look like 5, 10, 20 years down the road from now, and how are we setting the foundations today so that when that consumer adoption does come and we're starting to see hundreds of millions or billions of dollars flowing through these platforms, what does that look like, and how does that impact the kind of macro capital markets picture versus just kind of the more smaller scale syndication picture that we're seeing today.
All right, so now for something a little unusual. Something that I don't usually include in these podcasts. But typically before I do the recorded podcast with my guests, I have a little chat before and after we record. Those chats are off the record and edited out. So part of that chat with Adam today involved the expertise of his mysterious assistant, Clara. Clara coordinated the timing for the podcast, and I couldn't resist asking him about his assistant.
Before we sign up, I have to ask you, who is Clara?
Clara is actually not real.
Are you?
I am. Yes.
Okay, good.
I am very much so. So Clara, so we went through, when we first started the company, we went through Y Combinator, which is the accelerator down in Silicon Valley.
Yeah, I've heard of it. It's well known.
It was a company started by one of our batchmates that's this kind of, AI assistant, kind of robot assistant. And so there's some human interaction on the back end, but I don't know what percentage of it is all automated, but it's, largely automated. So Clara is not actually a real person.
Yeah, I kind of figured that out when it said, one of the emails that she sent said, refer Clara, you get $100. That's a curious signature. That's a curious signature line. I got to click on this link. So that's what I did.
So that must have been on a support. Usually that only comes to me. So that
I got to click here. Oh, maybe you forwarded something to me.
I might have forwarded.
And I scanned down and I thought, wait a minute.
That must be what it is. Yeah.
Just a minute. All right.
Yep. So that's
Adam.
You know our dirty secrets. Must be what it is. Yeah.
Just a minute. All right.
Yep. So that's
Adam.
You know our dirty secrets. That's about that's probably that's the biggest skeleton in our closet is Claire's not real.
Well, so when I was working at East West Bank, right, selling these notes, I never did phone calls. I wrote 60,000 emails in the course of a year. It was all email, right? And people would say somebody wrote to me one time and said, "Are you real?" And I said, "No, I'm just an autoresponder."
Exactly
I don't do lunch. Yeah, exactly.
Right.
This idea of risk-adjusted return is not a trivial one. As I discussed with Adam, the fact is that the crowdfund real estate industry has, as of today, only been around during the upward phase of the current cycle. It's just too easy to be lulled into imagining that real estate will keep on the same growth trajectory. Fact is, a downturn will come, and when it does, not only is that the downturn will bring. The best way to do that is to know what you're getting into, understand the intricacies like a pro, and be fully informed. And a great way to start that process, even if you have experience already, is to have a firm handle on the key terms used in real estate investment, which is, by remarkable coincidence, as I mentioned earlier, something I've compiled for you. Just go to the National Real Estate Forum.org website, nreforum.org/education, and I'll send you a plain English glossary explaining all the terms completely free. The next podcast will be with my good friend Chris Loeffler, founder and CEO of the real estate investment firm Caliber Companies. Chris is one of the few sponsors that I know is driving forward completely independently to do a Regulation A+ crowdfund raise for his company. And to unwrap that jargon, he's doing a mini IPO, which means he is selling a part of his company to the general public, accredited and non-accredited, rich and not so rich alike, in order to raise capital for the future growth of his company. Be sure to subscribe on whatever platform you listen to podcasts so you don't miss this or other episodes by going to the National Real Estate Forum.org website, nreforum.org. I've included one-click subscription links that you can find about halfway down the homepage. Thanks for tuning in, and thank you also to Adam Hooper, founder and CEO of RealCrowd.